All right. Well, welcome back to the show, everybody. This is going to be a smaller episode, a little vignette, if you will. We're going to try this out, releasing maybe 2 this week, this one and one more, just over small, specific topics to help you get a little bit of financial education as you go along your week. And we'll mix these in with our longer episodes. But this week, I wanted to talk about the Fed, which is the big news story over the weekend. If you saw yesterday, Jackson Hole, Wyoming, Jay Powell spoke over interest rates, and the market, of course, went down, and then it came back up for a brief moment, giving people hope, and then it sold off hard, down 1,000 points. NASDAQ closing down 500 points. That's 3% and 3.94% respectively. And so definitely threw some cold water on this rally that we've been having lately. And so when you look at this, why did Jerome Powell do this? Well, we had a good CPI number. CPI is the Consumer Price Index. It's the inflation number that everybody is so focused on this year. And in July, we saw it come down. And it was a small, so everybody's saying, okay, we have peak inflation. It's going to start coming down, meaning the Fed is going to take their foot off the brake, if you will. But Jerome Powell came out and he said, look, one number is not enough for us to slow down. We're going to have to see more data than that. We're going to press ahead. We want to make sure that we bring down inflation, not just a little bit, but a lot of it. And so it's going to take some pain for us to get there. And, he told the market it's going to take some short-term pain now, but it's going to prevent a lot of pain in the future. And what he's referring to is kind of like the 70s when inflation just kept going, because it gets ingrained in the system. And so then you have, businesses and people who are selling things, they just start raising prices because they expect the price to go up. And so you have to prevent that. And so even though it's not what the market wanted to hear, it's probably going to be long term. It is going to prevent more pain longer term. So you as an investor have to think about, okay, when people start getting a little too optimistic, it's never equal. People are either way too optimistic or they're way too pessimistic. And so, you have to be somewhere in the middle. You have to just be, keep your emotions keep your emotions in check and think about what are the good companies? Is this a good price? Do I want to invest in this? And quite honestly, I think, and I've said it in some of the other episodes that we're in for, 12 to 18 months of, pretty not hard times, but it's just going to be dampened compared to the previous years that we've had, where we've had so much growth and prosperity in the stock market. And historically, 1 out of every 3 years is a negative year. Now, one thing that we have to look forward to is that election years, normally the 6 months after the midterm elections is the best 6 months for the stock market for a presidency. So we'll see if that continues. Who knows? But really, for now until the end of September, when the Fed, has their official meeting where they're going to raise interest rates, it's probably going to be a little bit of no man's land in the market. And that's simply because there's really no reason for people there's no catalyst for people to want to get in except for accumulating shares at a good price. There's a lot of hedge funds that are having really awful years. And so you're seeing them chase a little bit. They might short the market this week, probably going to have a short, or not a short, but a down market coming up. I just don't see why anybody would be rushing in to add to investments or whatever until maybe the clouds clear a little bit. But if you have a long time horizon and you're willing to ride out some of this short-term pain, I do believe there are going to be many opportunities for you to buy into good quality companies, and you'll have a little bit longer window to be able to do that. So if you've been working on your list, thinking about what companies that you want to invest in, look at some of those. You go look at Google after the split, And I mean, it's down to $110 a share, which is in range of where most people can afford at least a couple shares there. And that's down from, $2,000 earlier this year before the split. So there are opportunities out there. You just have to be brave enough to kind of dip your toe in the water and go for it. So I hope that helps. Understanding what the Fed is doing is very important. There's an old saying that says, don't fight the Fed, right? And so, unfortunately, they have a better brake than they have accelerator. And what they're trying to do is slow down the economy enough to where it brings down inflation, but it doesn't cause widespread layoffs. And sometimes they send us through the windshield. So that's what's historically happened, where everything comes to a screeching halt. So they're trying to not do that, but we will see what happens. So that's it for today. I'll see you next time, and look for another episode coming out in a couple days. And check it out. Appreciate you listening. Thanks, everybody.